Welcome to this explainer. Today, we've got a very specific goal. We are going to completely demystify institutional market mechanics so you can finally stop being the market's liquidity. Look, if you've ever felt like the market is literally actively out to get you, you are in exactly the right place. We're going to pull back the curtain right now. We'll see exactly how the big banks and hedge funds actually operate, and more importantly, how you can start aligning your trades directly with theirs. Let's jump in. So ever had your stop loss hit to the exact pip just before the market reverses 200 pips right in your direction? Yeah, it happens to every single trader at some point. You do everything right, you set a tight, disciplined stop loss right below a major support level. The market dips down, takes you out by a hair, and then just surges straight toward your original profit target. It is incredibly frustrating, right? But you really need to understand this crucial fact. You didn't just get unlucky. That wasn't random market noise. You just served as the liquidity for a deliberate, highly calculated institutional trap. Section 1. The Retail Stop Loss Trap. Why support lines fail. Okay, let's dive into this by completely tearing down the most widely taught retail concept out there, the double bottom support line. Think about what happens when a red line violently pierces right below those equal lows. That is a liquidity purge. Major institutions, central banks and huge funds, they can't simply click buy with hundreds of millions of dollars. If they did, they'd literally move the entire market against themselves before their order even filled. They desperately need counterparties. So what do? They purposely drive the price down into obvious retail stop losses. They trigger your sell orders just to fill their own massive buy orders and then snap the price violently back up off a green institutional order block. It is the ultimate stop loss trap. To beat this, you need a massive philosophical shift. Just look at the difference between a retail entry and a smart money entry. The traditional retail trader gets super emotional, they buy the obvious breakout, stick their stop loss right underneath, and inevitably, they get stopped out. But the smart money trader? They are ruthlessly patient. They literally just sit on their hands and wait for that exact sweep to happen. They let the institutions accumulate the orders first, and then they buy right alongside the banks. That is how you consistently lock in those highly calculated 1-to-5 risk-to-reward ratios. Section 2. Understanding market liquidity, buy side and sell side. If you actually want to trade alongside these institutions, you first have to understand exactly where all this liquidity is sitting on the chart. Because honestly, if you don't know where the liquidity is, you are the liquidity. Like the rule says, to trade order blocks successfully, you must understand where liquidity sits. You've got to start thinking of retail stop losses as literal clusters of money just resting silently on the chart. Sell-side liquidity sits right below double bottoms or swing lows. Those are just sell-stop market orders just begging to be triggered. Meanwhile, buy-side liquidity sits clustered right above double tops or swing highs. And this brilliantly illustrates exactly what happens to those clusters. When you see a single aggressive candlestick wick sweeping through those equal highs, that's not an accident. Think of that zone as a giant skull, a literal graveyard of retail buy-side liquidity. The banks are deliberately piercing that level to snatch up those buy-stop market orders purely to fund their opposite sell positions. And the absolute second those institutional sell orders are filled by unsuspecting retail traders, boom, you get that massive dump downward. The real move happens, and the retail trader is left totally sidelined. Section 3. What are institutional order blocks? So now that the actual problem of these liquidity sweeps is crystal clear, we need to talk about the solution. We need to identify the exact zones where the banks are executing these massive reversals. Enter the institutional order block. This isn't just some random candle on your screen. It's a highly specific price zone holding massive clusters of unexecuted bank orders. On your chart, a bullish order block is typically going to be the last down candle right before a violent, aggressive upward expansion. Because these institutions have so much capital tied up in that specific zone, when the price eventually wanders back down to it, they are going to aggressively defend their position. That's what causes that sharp, predictable bounce. Section 4. The High Probability Order Block Checklist. Let's move to and see how this builds into an actual actionable strategy. Because look, not every last down candle on a chart is a valid order block. If you just go around marking every single one, you're going to get faked out constantly. We need a strict, objective filter. 3 rules. First up, displacement. The move away from the order block has to be incredibly aggressive, leaving behind a fair value gap, which is just a sudden rapid jump in price that leaves a literal gap in the chart. Second, structure break. That aggressive move has to actually change the trend on a higher time frame. And third, liquidity purge. The highest probability order blocks are the ones that form immediately after a liquidity sweep. Oh, and the zone has to remain unmitigated, meaning the price hasn't already come back down to touch it yet. So the crucial point is how we actually enter these zones, which brings us to the 50% rule, otherwise known as the mean threshold. If you want to drastically improve your risk to reward ratio, do not just enter blindly at the very top of the order block candle. Institutions love to retrace deep into the candle before they actually reverse it. So measure the order block from high to low and place your entry right at that 50% midpoint. That gives you a significantly tighter stop loss and a much, much larger payout. Section 5. The Precision Entry Formula. Okay, we've got the theory, we've got the checklist. Here is your highly actionable step-by-step blueprint for actually executing this on live charts. Step 1. Go in and mark your key liquidity pools on your 15-minute or 1-hour chart. Step 2. Wait patiently. Let the price sweep that liquidity and immediately push into a valid, unmitigated order block. Step 3. Drop down to a lower time frame and look for a change of character. You want to see a sudden shift in momentum proving the trend is reversing. That's your final confirmation. Step 4. Place your limit order right at that mean threshold we just talked about. And step 5, and guys, this is absolutely critical, set your stop loss just beyond the order block wick. You have to give it enough breathing room to survive those deep, last-second institutional tests. Section 6. Trading with smart money. To wrap all of this up, the biggest takeaway today is simply a massive shift in your mindset. You've got to stop buying the obvious retail support line. I know it feels safe, but it is a specifically designed trap. I want to leave you with one final thought to chew on. Are you going to continue letting the market hunt your stop losses, or are you finally ready to start trading alongside the institutions that are actually creating the moves? The choice is entirely yours. If you want to dive even deeper and see exactly how this looks on live charts, head over to the Money Blueprint Substock to grab their written chart breakdowns. Protect your capital, build your blueprint, and start trading with the liquidity creators. Thanks so much for joining me for this explainer.